So I've told you that the most important ratios which I admire generally in a company is ROA and ROE, because these two figures will tell you how fast a company could expand the business. We would want to buy companies which can grow money faster, isn't it? So I leave it up to you whether you want to see ROA or you want to see ROE, but either of them, the value should be high. The difference between these two will tell you how much of loans company has taken. Now, the answer is again both yes and no. Some people may like aggressive. Like you may like a batsman who is hitting sixers and fours, very aggressive batting like Virender Sehwag. But some people may like, say, Rahul Dravid, who is slow and steady. So it all depends upon management. Taking high loan means either very super fast growth or crisis during a tough time like COVID and all, there will be a massive fall. So I can give you an example of Lemon Tree. Lemon Tree is growing pretty fast. ROA and ROE both are excellent. But what happened during COVID times? The price went down to 17 rupees also. This was all massive fall because of COVID. Went down to even 16 rupees in year 2020. So in just 2 years, it is up around 5 times. But whatsoever, it was very risky that time because company had to pay the rent, company had to pay the salary to the employees. If COVID would continue for another quarter or another 6 months or another year, then it would be very difficult for this company to manage. But even then, with
So
guts, you got to. Yes? Any doubts?
recording the session, sir.
Yeah, I've already recorded.
Okay, thank you.
So during that time, during tough time, one thing that we are very clear that either this company will face a severe crisis, or if it survives this tough time, then it is going to go to sky. It is at trading at lifetime high now. But here what you need to think is, I told you efficient management, this is the talent they have. Definitely they would negotiate with the employees. Definitely they would negotiate with the property owners. I told you they do not have any of the hotels of their own. So whomever they are paying rent, they would definitely tell, see the times are tough. You got to negotiate on the rent. Just charge 50% for 6 months or 12 months or charge only 25%. Every business has done that. So that was likely to happen and it happened. Employee salary was cut by 25%. If necessary, even 50% would have been cut. So even during tough time, company was capable of standing. So that is the time, during the time of panic, you got to make a judgment whether this is going to survive or not. But if it does, you have taken that risk, then you are going to multiply money. Like this, out of 10 companies, maybe one will fail, two will fail. But if one company is also growing by 10 times, it will automatically cover the rest of the 9 companies under performance. But believe me, more than 5 companies will come out to winner. Always take the advantage of panic in the market, always. Because we are buying from long term perspective. Short term, lot of things will happen. They will come, they will go. But you got to stand still. Alright, so that's your ROA and ROE. And then another important ratio is debt to equity. So I was asking about the FMCG companies, like what is the ROA and ROE. So again, as expected, Praveen has done the work well. Let me quickly share the ratios of each of the prominent companies. So there is one company which I like, I've been liking since long time is Colpal, Colgate Palmolive. So this is the company, even if you remember yesterday in typing, I first entered Colpal. So Hindustan Unilever, Colpal and Tata Consumers and all these companies, when you compare, according to me, the price of Colgate Palmolive should be minimum double from here. So it is very much undervalued. Only problem is this company is only into oral hygiene. But doesn't matter to me because even today Colgate is a leading brand. So many disruptions it faced. Vico turmeric toothpaste. Then you had Patanjali coming up with an herbal toothpaste. You had this close up coming up. But still it survived. How? It also started manufacturing Ayurvedic toothpaste and all that. So company knows how it has to face the storm. And this is a one particular product. FMCG, why I always love is, no matter what may happen to the world, consumption will remain. We have seen during the COVID time and all, FMCG was the only business doing good. Imagine the entire world is under lockdown. Apart from FMCG and pharma, tell me one business which survived. Nothing. So these are the two businesses which are said to be defensive business. That is why I told you when the times are tough, when we are in the pessimism cycle, every big investor would want to enter into these sectors. That means they do not want to take risk. When things look risky, when times look tough, these two companies sectors stand out. And that is how we are also going to adjust our portfolio. So will it be the right time to buy Colgate? No. First have a look at the ratio. It looks very tempting. Shri Hari has also done the homework. I tried to do the homework, but I was stuck in the middle, means I have problem in doing the analysis. I need some help. Okay, no problem, Hari. Keep working. Anywhere you are stuck, just send me a screenshot or give me a call on WhatsApp, send me a message. I'll try to help you out at the earliest. Hindustan Unilever 18, Dabur 29, Gillette 33, Britannia 63, Nestle 102, Tata Consumer 9.2. That is your ROE component. But if I want to see the margin of safety, then I would be seeing ROA. So among all the, because Colgate Palmolive is taking only 50% loan on equity. So even when tough times come and all, unlike your Lemon Tree which faced crisis, this company would still stand out because hardly it has taken a loan, and that is when the consumption falls. Now question is, why would an oral hygiene consumption fall? I can think about some other FMCG sector like Gillette India, why the consumption may fall. Okay, so maybe people will be using when there is recession and all that. I told you everything changes here. The mindset changes. Every sector gets affected. So people who are using the razor blade for 2 months, they may start using it for 3 months, 4 months. That's a direct hit on the growth to the company. First of all, there is already a lifestyle change, which is a big disruption that it is already undergoing. But even going forward, if people become very conservative, then definitely the volumes will fall. Nestle and Britannia, these two also look excellent from ROE perspective. Okay, but the loan component is high compared to Colpal. And if I look at the share price, Colpal has been trading in a static range for a very long time. That means there's a lot of underperformance compared to peers. The price was 1795. The price was 1151 in the year 2018. That means it has hardly grown by 50% in 5 years, whereas other companies like Hindustan, Unilever and all, like that, when you are free, try to check the chart of each of them. They have grown up by double the speed. Though the ratio of Colgate Palmolive is better than them, yet they are trading very, very expensive compared to it. So here, not only this, even if you look at the PE ratio, you will be surprised to see the PE ratio of these companies. It will be very high. Maybe one column we could add even for PE ratio. So price per earning multiple, let us quickly go through these companies. It will be like 40, 50, 60, 70. So that's very expensive. P ratio is 61.3. Okay, just check. What is the TTM? Trailing 12 months. So 61.3 is a very high P ratio. That means company is trading at 61 times net profit. I'm investing in a business with 1 crore and my profit is 2 lakh per annum. Is it a sound business? Definitely not. Though all the FMCG companies P ratio will be high only. That's why I told you compare apple to an apple, orange to an orange. I should not decide by just looking at the P ratio of Hindustan Unilever stating that it is 61, it is high. I should also be checking the P ratio of Colgate, Dabur, then you have got Tata Consumers, Britannia. Britannia P ratio is again 60, so that is in line. Hindustan Unilever, Britannia both have got 60, means we can now set a benchmark. Okay, 60 seems to be an average, but let us see more. Let us take Nestle. P ratio 90. So let us take a benchmark as P ratio of 60. So an FMCG company should be trading at 60p, then it is said to be reasonable, because that is how all the companies, not only in India, even in Western countries, are trading, like Johnson and Johnson. Now what we'll see is what is the P ratio of Colgate Palmolive. It's an international brand, guys. 41. So company already seems to be very much cheap compared to its peers on a PE front, and company looks double cheap when I look at even the ROA ratio. According to this ROA ratio, this should be trading at a minimum 80 PE. That's why I tell you the price of this company should be minimum double from wherever it is. But would I buy this stock? Not even a single share of Colgate Palmolive is what I would be buying today. Why? Because very clear cut answer, we are in old economy cycle. My portfolio should consist of all the old economy stocks. And what is FMCG? Defensive. What is pharma? Defensive. But when the crash comes in the market, when we enter into the pessimism phase, that time one company which will attract me would be Colgate Palmolive. So that is why it's a good investment, but not, the timing is not appropriate right now. Wait for good time. Simple. Coming to debt to equity, how much of loan a company has got with regard to net worth? A debt to equity ratio less than 1 is always healthy. How much of loan a company has got with regard to net worth? A debt to equity ratio less than 1 is always healthy. How much less it is, that much better. If it is 0, it means that company does not have loans. Yes, any questions? All right. Now comes another. Voice is very low. Could you speak little louder? All right. So an example, a company net worth is 100 crore while loans are 50 crore. So see, loans means short term loan, long term loan. If you go into balance sheet, you'll find both of them. Add both of it. So debt to equity ratio is 1:2, which is equals to 0.5. So anything less than 1 is okay. Beyond 1, it is like high speed, chance of accident. Either you will make money very fast or you will lose very fast. Riskier investment. I prefer companies mostly which hardly have any debt. So I had recommended a company, Goldium International. Did I recommend here? No. I recommended in the WhatsApp group. The company price rose by 12% in a single day, even though market was down. That is how you get the outperformance, guys. Though the mutual funds were down, though the stock market was down, but still a single company could have given you 12% return in a single day. Every day it will not rise with that quantum, but I told you, think long term. Think from 1 year perspective, what has market given to you, what has mutual fund given to you, and what is that your company has given to you. This is very important. There are few applications wherein directly it will show you the debt to equity ratio. Let us see that for Goldium International itself in moneycontrol.com. Manually, how do we check? And automatic calculated debt to equity, where can you find? If you scroll down, first of all, P ratio and all that you can see. Debt to equity. How much is it? This is what I want. This will tell you the margin of safety. A lot of people tell me, don't invest in small cap stocks, don't invest in penny stocks. I feel the real value is here. If you want to grow money faster, then this is what you got to do. Do proper analysis. Don't buy a company which has got 0.9, 1, 1.2, 1.5, 2 debt to equity. So we are looking at consolidated, always look at consolidated figures. So this looks very, very attractive from debt to equity perspective. ROE, amazing. Look at the graph, how it is rising. ROE of 20, I told you less than 10% companies are present in the exchange. P ratio reasonable. Debt to equity least. So let's go into the balance sheet and find out how much exactly is the loan compared to total assets. And we'll come across a figure called as book value. Okay. So this also you have to keep in mind. Later I'll talk about it. Now let's go into the balance sheet and find out what is the total loan, short term and long term. Long term borrowing zero. Okay, long term borrowing zero, that means no long term loans at all. Short term borrowings also is zero. Short-term borrowings is also zero. It means that company is totally debt-free. Is that clear? And look at the current investments. That means company has invested some bit of money into the stock market or maybe mutual fund, whatever. Plus, it has got 53 crore of cash balance in bank. 53 crore is cash balance in bank. Forget about taking loan. This company will give loans to others. This is the margin of safety you are getting. So among the total assets of 293 crore, I am saying that 53 crore is only the cash component the company has got. Very, very attractive investment, guys. So this company should also be part of your portfolio if the price falls down, because it has suddenly risen 12%. Don't buy it, don't chase it. I bought in Sri Hari's account at a very low price, 124.25 I think, just 2 weeks back. So like this opportunity will come. Wait for panic. Keep this company in your radar. Any day because of some bad news or because market falls. See, just tell me one thing. Now how fundamental analysis will help you, I'll tell you. 90% people who invest in the market, what they'll do? WhatsApp circulated message, buy company ABC, buy company XYZ. They buy it without looking at any ratio. They just see the chart, okay, it is flying higher, they buy. When market crashes, they don't know what to do. Because they don't know what to do, they will come in panic and they will sell. But what you know is, I know that the company is sound. Goldium at 138 rupees looks very attractive because of huge cash component, zero debt and less PE ratio and a good growth and good high ROE and ROA. Both will be same. ROA and ROE will be same. Why? Because debt is zero. So that means by every means it looks like a fantastic company to buy. At 138 itself it looks good. Then during the time of panic, if it is available at 120, what will you do? You'll buy more. At 100, what will do? You'll get excited, you'll buy more. So this is the difference between knowledge and non-knowledge investment. Had you not known about this company, you would feel that a price from 138 is going down to 120, 120 is going down to 100, 100 may go to 80, and then 80 may go to 60. Like that, in panic, you'll sell at 100, and from there it will shoot up and go to 150. I made him buy this company because it is already available at a discount. If you look at the price chart pattern, every company we choose will be like this, guys. It was trading at a high of 206 and we are buying at, we bought at 125. So we are already buying 40% cheaper. Even at this, it looked very good to buy. This is a Fibonacci technical point which we'll understand later. So technical charts were also saying that this is a good time to enter. And fundamentals are anyway strong. The cash component of the company is increasing. By all means, company looks an amazing buy. So buy even at this price, because if you compare with the high, you are still getting it at much cheaper. 32% discount. But there may be a chance of getting at 40% discount, 50% discount. So wait for it. Maybe today it may fall a bit because of market falling badly due to the Fed event overnight that we had. So we are going to open lower. But from there, where we are going to go, that your RBI meeting would decide. But we are not investing here for a day or two. We are investing from long-term perspective. Imagine when this company's cash component increases 50 crores to 60 crores, 60 crore to 80 crores, then it will come under notice of big investors like Rakesh Jhunjhunwala, Hillspot. Arey, the diamond is available here, so cheap, let me buy. The moment he enters, the price will shoot up. So we are just waiting for some big investor, tycoon, to enter into the company. The price will fly like anything. This is how the entire game of stock market is. Alright. After ROA and ROE, what is that I look for? My voice is breaking. Is it the same complaint from everyone? So that I get to know whether the problem is from my end or your end.
For me, it's clear, sir.
Okay. Then the problem must be from your end, Bhargav. Alright. Anyway, I'll be sending you all the recordings and all. The sessions are getting recorded. I've been uploading that in the YouTube, and once all the links are ready, I will be sharing with each of you. After ROA and ROE, what is that I look for? Very important ratio. What big investors see is free cash flow. Very important, guys. What is this free cash flow? A company, let's say that I started with a business with 100 crore investment. Let us say cement factory. Cement factory, I'm running a business, and then after 1 year, I show a net profit of 20 crore. After 1 year, I show a net profit of 20 crore. Now, what you may think is that 20 crore is a bank balance. Need not be. It could be 30 crore also. How? Because in my accounting report, what I'm saying is that 20 crore is the 30 crore is my cash balance, but 10 crore is my depreciation. What depreciation? Machinery depreciation, vehicles depreciation, ACs depreciation. Like that, all this I show as a my 10 crore expenditure, which is actually not expenditure. So my bank balance may be 30 crore, but to see net profit may look like 20 crore. That is why cash flows are very important. Now, second business I'll compare. Real estate. Real estate, I may show my net profit as 20 crore. You may see that in the down there is a 20 crore figure, so maybe 20 crore bank balance company has got. Need not be. Company may have purchased another land with that 20 crore. Company may have cleared the loans with that 20 crore. So what is he doing with the net profit? That is very important. That is why free cash flow has to be seen to know the real component of the bank balance increasing. I love the companies whose bank balance increase like Goldium International. See, you may claim 100 crore profit, you may claim 200 crore profit, but what are you doing with that money? If it is a real estate company, they'll continuously invest in land. So the free cash flow for real estate companies will be very less. But for IT companies, it will be very good. For FMCG companies, very good. Let's say IT company, they'll make 20,000 crore profit. What to do with that? 2,000 crore after paying salary and everything. After paying tax and everything, they have made 20,000 crore in the bank balance. So they are not here to put that money in bank. They are going to use this money for buyback. I'll tell you what is buyback after a while. So when they come up with a buyback, they purchase your shares for a premium price. Else they will come with a dividend. Else they will clear the loans. First of all, they are all debt free. So such kind of free cash flow is a kind of blessing in disguise for any company. And if you ask me, out of 7,000 companies, only 1,000 companies, less than 1,000 companies have strong free cash flows. Let me show you one company which I like in this category, that is Hisar Spinning. Cash EPS, I'll get back to this EPS figure, is 15 rupees. Now, which means that ROE first of all is very high, and cash EPS is 15, means in 55 rupees share price, 15 rupees is only the cash for the last 12 months. I am not at all talking about the previous years. I am saying only in the last 12 months, company has made 15 rupees cash profit. What is the P ratio, guys? Just have a look at it. A must buy. You know, I bought this company share price at 32 rupees. Even at 55, I am buying. Even at 55, more than 70% it rose, yet I am buying. A company which it deserves in everyone's portfolio. Very safe. Let market go to hell. So EPS is earning per share. So company has made more profit. I'm not talking about that. Only the cash profit is 15. And I always told you that buy very low, small size companies whose free float market cap is very less. So every way it looks like a fantastic buy. P ratio only 4.49, cash flows are very strong, ROE is high, then your P ratio is less, free float market cap is less. Fundamental every parameter it fits, guys, every parameter. Like these 10 super solid companies you hold in your portfolio, one jockey will fly higher, it will go into the sky. Maybe this company will be trading at 200 rupees also. With such kind of companies, you will not lose. Doesn't mean that the price will not fall. Price may fall, but it will bounce back very fast because company is available cheap. Just like saying gold. See, gold prices keep moving higher and lower, higher and lower. But every time that it has fallen, it has risen very quickly. Every time that it has fallen, it has risen again quickly. Real estate, every time that it has fallen, it has again risen. Because there is some fundamental value. Na? Company cannot give cash just like that. He will do something with the cash. Likely buyback, likely dividend. Like that, you'll be getting some extra credits, rewards. I'm saying 15 rupees if he's making per year, let it run for 3 years. 55 rupees will only be cash. Then this company will be available for free. I am doing a business with 100 crore. No loans, first of all. In 100 crores, I am making 25 crore net profit, which is going into my bank balance. For 4 years, if I run like that, then I have totally made my factory free. Isn't it? Then what is the value of my goodwill of my business? What is the value of the other assets of my business? That also should be counted. Na? So why would you make loss? I do not find even a single reason why the price of this company should trade less than 55 after 4 years. That is the margin of safety you have. Warren Buffett says, to make money in the market, only remember 2 rules. Rule 1, do not lose money. Rule 2, do not forget rule number 1. What Warren Buffett says is margin of safety, margin of safety, margin of safety. He says that you don't worry how much the price will rise upwards, but you worry how much the price can fall downwards. You only focus on this thing. Automatically these companies will become expensive that time you sell. It's only a matter of time. Let big investors pour in, you'll see the price going higher. And definitely, they see Vijay Kedia, R.K. Damani, then now it was Rakesh Jhunjhunwala, but now someone else is taking over those assets, managing those assets. Like that, there are plenty of big investors. They'll have 20-30 employees whose job is every day to find out which company to invest, which company to invest, which company to invest. Every day they are researching 100 companies. One day this company will come in their radar. You are buying lower, they'll buy higher. That is the difference. Definitely, you can keep this point in mind. Some big investor will definitely enter Hisar spinning because the value is very, very cheap. And that becomes a trigger for the price to move higher. Because then what will happen? It will go to public. Everyone will get to know, Arey, R.K. Damani has bought Hisar spinning at 60 rupees. The price will open 20% higher next day. Like that, within short term, 3 months, 6 months, the price may become double. Then public will enter. That time we exit. Then we'll choose the next Hisar spinning. That is how we'll try to compound. Alright, hope this point is written. Now coming to the next ratio. Okay, free cash flow right now. CapEx means capital expenditure. The next important thing, even more important than PE ratio, is actually EPS. Average experienced people, they check the PE ratio, but people who are very thorough with the market, they actually check the EPS. EPS will give you a better picture than even PE ratio. Average people will look at the net profit growth of the company, how every year on year the company is growing its business. That's what they see. But EPS is one thing which will give you the true picture of growth of the company. With an example, we will see how net profit growth and the real growth of the company can deviate, can divert. How is that a net profit can misguide you? So do not ever check the net profit growth, guys. Always check the EPS growth, because EPS cannot be manipulated, net profit can be manipulated. Write down, then I'll explain. Very important ratio. So according to me, the four most important ratios for any company would be ROA, ROE, EPS, FCF. These four things, if you check, sufficient. Don't require to check debt to equity. Don't require, everything will come in this. Don't require to check your book value. We'll discuss about book value also. Don't require to check assets, liabilities, anything. If you want to go in detail, you can check all of that: operating profit margin, net profit margin, sales turnover, sales growth, net profit growth. Don't have to see all that. Just these four ratios you see, you'll get to know at least whether this company should be part of your portfolio or not. If it deserves to be part of the portfolio, then go deeper. Otherwise, leave it. Choose some other company. Hope it is clear. There's another company, very quickly I'll show you. Gujarat Container. This also should be part of your portfolio. Company is already available at a huge discount. Let's see first how much discount are you getting. I bought it in fact at 207, 208, and you are able to get this company at a discount of 273. It had gone just in 7th October 2022. 1 month back it was 273. Now you are getting at 175. So it's even at this price, it is a buy even today. Don't have to even wait. What is so special about this company? Let's have a quick look at it. The speed of growth. Very ethical management, and the speed of growth is very, very high. So P ratio is only 8. I told you PEG ratio, right? Price per earnings per growth. This is the EPS. We'll discuss about EPS. Both are related, but net profit, it may look like high, but it may misguide. That example we'll see how it could misguide. So in case your already Demat account is ready, then this could be the first company for you to enter. How much you're tempting a company might be, don't be in a hurry to buy. Because we have seen a very good fall, now is the time to buy. Keep buying it as the price falls. How much more it falls, that much more and more you got to buy. Look at this. So no consolidated, that means only one business, standalone business, so totally dedicated for the business. 75 crore becomes 87 crore, becomes 150 crore, that is only the revenue. Net profit, look at the way it is growing. This company was nothing. Now the real working has started. It has got a long way to go. Long way. Earnings per share growth, book value per share, ROE, everything looks fantastic. Look at this growth here, 5.2 to 20. This company is not growing by 20, 30, 40%. It is growing by multiple times. Exponential growth. Tell me what is the PEG ratio now? The company is growing at almost 4 times, and it is available at an 8 P ratio. So 8 divided by 400. PEG ratio less than 0.1, guys. I told you 1 is a normal value. Even if I say that the price should be 300, let me tell you, it is underrated statement. According to me, believe it or not, the price of this stock should be at least 500. True value is 1000 rupees. Till 500, you should not even think about selling one share. I won't sell even a single share, at least till I see 500. Such kind of companies you have to choose. Small company. I love small companies, speedboats. But do proper analysis. 90% small companies are fraud. I'm only showing you good doesn't mean that all the companies are good. I have already filtered out. If you randomly check, you'll say, sir, what are these figures for the companies? But the cherry on the cake is what we are seeing right now. So such companies should be in your portfolio. You will definitely make superior returns. 30% is a very conservative target, guys. At least you should be making 50% per annum. Then only in less than 2 years you'll be able to double your money. And in 20 years, if you are doubling your money even in 2 years, in 20 years it becomes 1,000 times. Even 1 lakh may become 10 crore. Small but steadily keeps on growing, compounding. And who knows, could be we can make more than that also. Doesn't take even 20 years. If you compound it, it takes 15, 16 years. That's an amazing wealth, isn't it? I'm sure no asset class would give you this kind of return, neither Bitcoin nor your land. Short term, maybe they'll outperform, but in the long term, your core portfolio would perform much better than even mutual fund. Fixed deposit, gold, whatever that you may talk about, no asset class has got this type of outperformance if you have knowledge. EPS is nothing but net profit divided by total number of shares. So when I see here as EPS for Hisar Spinning as 12 rupees, what it means, if you have invested 55 rupees in a business, you have made 12 rupees in 1 year. Isn't that a great return? Yes, of course. No doubt it's a great return. At least for a listed company, with such an old company with goodwill value, if you are making nearly 20% return on the invested capital, that's an amazing return. Very hardly you'll find such companies. Imagine Hindustan Unilever, on 1 crore you are getting 2 lakh. Here on 1 crore you are getting 25 lakh. That is a business. And from stock market perspective, this is an amazing return. You may say that 20% is not great, even factories make that. But in stock market, even 10% return if you are getting on capital, then the price is considered to be cheap. So at least 100 rupees it should deserve, then we say that it is still cheap. Now, cash EPS, that means how much of net profit is getting in terms of cash with regard to share price. That is 15. Now you will have to tell me why is that there is a difference here. EPS is saying as 12, but cash EPS is 15. I've already discussed this point. What did I tell you? Net profit may be 20 lakh. It may show in the balance sheet as net profit 20 lakh, but in real it may be 30 lakh. How? They are saying 10 lakh expenditure for depreciation. Like that here also company 3 rupees per share. They are saying that machinery value loss. These are all games, to pay less tax. But they can do this for 1 year, 2 years, 3 years. After that, machine value will be zero. Then everything will be only cash EPS. This will be here. So the real growth story is yet to come. Cash balance is increasing. I am expecting a big dividend or a buyback from this company. What is this buyback? What is this dividend? That will come in next class. Now I'll show you a company where net profit could misguide you. SEL Manufacturing, fraud company. Even I got trapped that time for once, but then I realized, okay, this is all the games being played in the market. When the times were tough in the year 2007-8 when I entered into the market, are you able to see this chart? Like Union Bank, this company price was also moving higher. And remember Union Bank, there was a fundamental reason. Here it was an operator game. Filthy operator. The market was going like this, but this company was growing like that, attracting everybody. See, I am the only one king in this world of stock market. I am rising. Like that it attracted a lot of crowd. what happened after 2008? See here, date 2008. Okay, these dates are important because what I'm going to show you now, you'll have to compare that. Till 2008, things look very, very good here. But then what happened that from 2008, still we are in 2008, see there, October, the price already fell down by 90%. Then it kept down, 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 and the price went down all the way till 2 rupees, 1.8, 1 rupee, my god, 90 paisa, 70 paisa, 60, 45 paisa in the year 2022. Look at the game. Now you'll know how good stock market is. And today, what is the price? 630. So had you invested even 40 paisa in this company in the year 2020, in just a matter of 2 years, you would have grown your wealth by 1300 times. Forget 1300 times, you would have grown it by even 3000 times. Your 1 lakh would have already become 30 crore in a matter of 2 years. Looks very interesting, right? Now I'll tell you the game. First, here was one game played. Secondly, here is a game played. That's why I tell you knowledge is very important in market, and knowledge should be complete. Half knowledge is in fact dangerous than zero knowledge. A zero knowledge person will invest in mutual fund. Those fund managers know these games. You won't get trapped in mutual fund because of these kind of stocks. That they are very clear. They are 30, 40, 50 years experience from the background of IIMs and all. Chartered accountants. They know every game what a company can play. So for zero knowledge people, they will hear the advice of some good people, or they'll invest in mutual fund. I love them. Then there are smart investors who do their own self-analysis and then they invest. That I love even better. But the third category of the people who are in middle, who have half knowledge by looking at net profit growth and all that, they invest. They are the ones who make maximum loss. So now here, let's come to the story. What is the game the company played? So I'm going back to the year 2008 to see how the working was. It's good that in Money Control we can see the historical records also. So I want to see the net profit in detail for the previous years. See, everything is falling. Then why the share price rose? That also we'll discuss. Consolidated. So this company, by looking at the graph, it looks like rags to riches, riches to rags, rags to riches, isn't it? Such a volatile movement. Okay, 2008. Revenue was increasing. 400 crores becomes 600 crores. 600 crore becomes 962 crore. 960 crore becomes 1600 crores. 1600 crore becomes 2200 crore. All good, right? Everyone agrees to this. Sales are increasing. Companies reporting 1 year, 2 year fraud means we can understand. So this is not fraud, guys. This is a real growth company had got. Then in the year 2008, company already made a high. See here. 2009 was good, 2010 was good, 2011 was good. Why the hell the price fell down by 90% then? That is where a lot of public got trapped. They are looking at the working and they thought that, this company price should be not 600, it should be 1200. This company price not should be 1200, 2400. It should be 4000. But they were getting at 70% discount, 80% discount, 90% discount, 95% discount. They were buying, 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 buying. And even after 15 years, forget making profit, they have lost their capital. You may say again the price has come back. It hasn't come back. I'll tell you what is the story there. First of all, understand this story. So companies' turnover was increasing. Companies' net profit was also increasing, guys. See here. Wouldn't you buy? Tell me honestly. If a company is trading at 600, it is available at 400 after this kind of performance, you would buy, forget 400, you are getting at 100. You would buy definitely at 100 at 80% discount. You would buy at 50, you would buy at 20, you'll keep on buying. And then you'll realize why the price is going under 1 rupee. Why it is trading at 40 paisa. You have already lost 99% of your wealth. 1 lakh invested becomes 400 rupees. The real game was seen in EPS. Are you able to see the EPS growth here? Company's net profit had grown. That is where the first warning signal had to come to you. 53 crore becomes 126 crore. According to EPS, net profit only, na? So net profit and EPS should go hand in hand. But what happened to EPS here? 29 had become 10. 29 should have become 58, it has become 10. That is where the game was already known. So what did this company do? I will tell you now. So whatever the figures of net profit and revenue we have seen is totally right. Question comes here, biggest question comes here, why the price crashed 99.9% despite such kind of good growth? I told you, jockey is more important than horse. Which business you are investing, that is secondary, but who is running that business, that is primary. We want business to be run by efficient management. Even though the business may not be efficient, but if the management is efficient, you will somehow, he will take out that company from crisis and grow it. I told you, example is Steve Jobs. Now that everyone faces tough time, but how do they come out of it is the talent what the management has got. These promoters are totally fraud, cheaters. Bloody, they have looted the money of the public. Unethical. They have taken all the curse of the public. They are already very rich. When they saw that there is a phenomenal growth in the company, they conducted a board meeting and they said that we want to issue 4 times shares. If there are 100 crore shares, they gave 400 crore shares at 2 rupees to their family members. Is this good? I started a business with 100 crore with you as a partner. You invested 50 crore, I invested 50 crore. After that 50 crore became 500 crore, I suddenly say that, see, I will bring my 4 family members also. They are also now equal partnership. They will all invest 100 rupees. 400 rupees, now they are also my partner, our partner, equal share. How does it sound? That is what company did. So company's net profit was growing, but the number of shares, new shares, he issued to his own family members for a very deep discounted price. The big management, the big investor, they lost the faith in the company. अरे चोर आ गया, निकालो इसको. That's why the price came under panic. Because no one would want to enter. Very clear, promoter is fraud. Company may be good, profitable, everything, but that guy doesn't want to give you money. He will do everything for that. He will eat money himself. He doesn't want to. So greedy that he doesn't want to share with others. He only wants to have for himself, for his family. That is very bad. If public has trusted you by buying your shares, you should maintain that trust. But now question comes, why did our government allow it? First of all, government has got nothing to do with the market. There is no such rule in the stock market wherein new shares cannot be issued. Every company does that. But good companies give new shares at a premium price. Whatever the price is there, at that price or at a higher price. But this guy gave at a discount, not only discount, deep discount. That was bad. It happens once in 1,000 companies. And this, unfortunately, this company was one. I also lost good money in it. Lack of knowledge. I did not used to check EPS at all. But books have told me, not net profit, check EPS, check cash EPS. If games are to be played, they'll play in net profit, but they cannot play in EPS and cash EPS. So earning per share, when it was reducing, that doubt you should have already got it. Something is not right, something is not right, something is not right, and you would have avoided buying into this company. Very first year itself, you would see that net profit is growing, but cash is not going in line. Doubt has to come. Even at 500 rupees, you should get that doubt. So maybe 100 rupees loss will get out, but you will not wait for 1 rupee penny price. Then what happened all of a sudden that the price shot up from 40 paisa to 600 rupees? Has the management become good again? No, management fraud is a fraud. Now there is a big stamp on him, red flag, chore management. So you may think that 40 paisa stock has come back to 600 rupees. No, a 40 paisa stock is only become 60 paisa. How sir, we are seeing 600 rupees now. This company's second game what he played is 1,000 shares he consolidated to 1 share. That means if you were having 1,000 shares of ACL manufacturing of 40 paisa, that share quantity automatically in your demat account has become 1. You have 1 lakh shares that have become 100. That's the consolidation he did. That is why the price may look 630, but you divide it by 1000, that is the real value. So these all games are being played, and this can be done according to SEBI. Company can go with consolidation of shares, company can go with issue of new shares. It is up to you to whether invest in that company or not. And that consolidation news you may find anywhere. Let's see if we can find. You'll have to dig deeper, but definitely that consolidation news is there. Okay, reduction and consolidation of capital. BSE India official site, so we can trust on it. See here, equity share capital from so much value has become so much. Just add 3 zeros, it will be same. This is the game he played. So do not ever believe what you are seeing. Go deeper and find out. DNA check is important. We go into the DNA of the company and invest. Today, 60 plus clients have given me their account totally. Sir, you do whatever you want. I am only buying and selling since 2-3 years. Every stock that I buy is a penny stock and small cap stock, but haven't come across such kind of companies in their investment. So that trust they have it because they have seen. That why they have seen like what is that, where the traps are there and all that. So these all things will at least save you from bigger traps. Hope it was an interesting session. That is all for today. I end here. And to inform you, I thought of informing yesterday, but tomorrow, day after, and then till Sunday, I would not be available. I will be on a trip to Chennai, so there will not be any classes till Sunday. So it's a long weekend for you. I want you to work with your favorite companies and find out what looks good in it, pros and cons both. Any of your 3 favorite companies. Why they are good to buy, why they are bad to sell. That means they are bad, that's why you may want to sell it. So why is that so? That you'll have to find out by look at all the ratios that we have discussed till date. Alright. So any doubts or questions, you can use the chat window or the audio control.